Hello everyone, thanks for watching. Today I'm going to go over a volatility trading strategy which is similar to a vertical credit spread, but it takes advantage of markets being richer or cheaper. So first of all, as you can see in this, we have SPY and the E-mini S&P 500 contracts. Now we're looking at the same date, 26th of June, or 22nd of June, and let's say in this hypothetical example, on the spot underlying S&P, I have two theses. I think volatility is going to go down, and I have a bullish thesis on price action. So the typical trade I would execute is I would look at maybe like, let's just talk about a 20 delta. I would sell the 20 delta to buy that 17. I would collect the premium difference between them times contract multiplier. So if we did 20, 30, 40, 50, we'd be collecting credit times, we'd be collecting credit there. And the biggest thing about credit vertical spreads is you want to make sure that you are getting the most premium for what you're selling. For instance, on the more you can collect premium through this transaction, the higher likely your trade's going to fare well. And even if the market goes a little bit against you, if you can squeeze some more premium out of that vertical spread, you can end up eventually being able to watch a mark to market go against you. Now, what is the strategy I'm discussing? I'm talking about, let's say the spot underlying S&P, we keep our thesis, but we want to extract as much premium as possible, especially if we're on leverage. Why don't we take options that are slightly richer or more expensive and make our selling leg on those? And why don't we take options that are cheaper, the premium's less, and buy? So not only are we going to have the game of selling to buying, but we're going to be paying slightly less on the cheaper market and selling slightly more expensive on the richer market. And with my previous quant finance video, I went over this project right here, and I'm going to bring it back up. And this converts options premiums from a future to an ETF. We use a ETF index, and in this example, this is a little before, but the general thesis, because of retail trading, holds true that the SPY ETF options premium is slightly richer, especially as you get closer to the money, than the premium on the E-mini. And you can also see when we take financing fees and hedge ratios, and we basically convert the E-mini to the SPY price like you would do a futures to its cheapest to deliver, you can see not only are options cheaper on the E-mini, but the probabilities are closer in time, so you almost have that sort of gamma squeeze long on those E-mini options, plus you're paying less for them. So the trade I would talk about in this situation is we would go here. We put in our hedge ratio of futures to ETFs and our contract multipliers. So with a assumed hedge ratio of 0.1 ES per SPY and that multiplier, we get a delta neutral hedge of whenever we sell of the same deltas of SPY to ES, it would be 5. And you can slightly variance this a lot, but with this strategy, we're going to be selling roughly the same deltas, and it's going to be a vertical spread, almost like a same delta vertical spread, and our premium we collect is actually from the differences in the markets, not the differences in delta. So if we go here, we're looking at that 22nd of July strike. Let's find equal deltas. Let's look at 14 delta. So what we could be doing here is we could be selling 5 of this contract and buying 1 of the 14 delta on the ES. And I'll get this configured to where it would match, but you can pull up your order ticket, even on Thinkorswim, and you can play around with modeling and whatnot till you get that delta neutral when you activate the trade. And what you would see is you're collecting a slight premium um, by selling the delta on the SPY and buying the same delta on the ES. And that premium you're collecting is because there is uh, slightly richer volatility. If we look here at the IV, that's 9.91%. On the same date on ES, it's 8.88%. So when you sell and buy at a delta neutral hedge from the SPY to the ES, you're actually trading the volatility difference between the underlyings. And the common street thesis as to why there is a difference is because retail participation in SPY drives the premiums up, less retail participation in the futures options market has cheaper premiums. Anyways, that's a way that you can trade, and this works especially well on dates where there is large retail ETF participation. Like today is right after a Fed meeting yesterday, and this allows you to collect that premium that comes from differences in the amount and the type of participation in markets. Anyways, thanks for listening. I hope you all have a great rest of your day.